Coming up on today's episode, it's like you treat your accountant like someone you see once a year.
That's right. And let us know when you've sold a property.
Oh, do you get that and people don't tell you?
Yeah, well, sometimes I find out after the fact. Let us know when you're thinking about doing it, rather than just doing it and then saying, well, what's the capital gain? Like, how much tax do I have to pay now? Like, we would have told you that in advance if you just let us know.
Would have planned it out with you.
Yeah, exactly.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Joe Agresta, and it's time to take control of your property journey together.
Hey guys, it's Daniel Demirci here, Director of Mark Daniel Co. I'm back here again to speak with Joe Agresta from abodey, all things tax, and how we can use tax minimisation strategies to build wealth. Let's go.
Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Joe Agresta. Today, we're simplifying a dense but essential topic, the main taxes that touch property, how sophisticated investors legally minimise them, and how your accountant should be steering the plan so you keep more of what you make. And my guest is a returning guest, Daniel Demirci, Director at Mark Daniel & Co. Daniel is a registered tax agent who lives and breathes property. He advises buyers, investors, and small developers on tax strategy, ownership structures, CGT outcomes, which if you don't know is capital gains tax, depreciation, and long-term portfolio planning. In short, not just tax returns, actual wealth strategy wrapped around real estate decisions. So if you missed our first episode together, that link is in the show notes below, so go check it out. You can learn more about Daniel's background. We broke down some great topics in that episode. But without further ado, Daniel, welcome back to the show.
Thanks, Joe. It's good to be back again.
We're back at it again.
We are.
With a dense topic that I know I'm going to make fun. And that you're going to make fun too, because I wouldn't imagine doing this with any other accountants, but I've wanted to, but you've got the best personality for it.
Thank you. I'll try my best.
I think you'll do well.
Thank you.
Very excited. Because I want to set up before we get into it, just a one-liner about yourself for those who haven't listened to your episode. What do you help property clients do that a typical lodgements-only accountant doesn't?
So what I tend to do is I tend to look at overall the tax situation of the client, see how they're structured in terms of their investments, etc. And I'll also brief them on, other types of strategies that they'll do rather than just lodging an individual tax return at the end of the year, putting in a few deductions, etc. for the property and off you go. We'll actually have a look to see, what type of strategies we can actually implement in order for them to maximize their outcome and also trying to build their wealth position as well.
I love that. And this is exactly why you're the perfect guest to have on, because I want to set the foundation before we get clever, right? If you're a first-time investor, these are the taxes you need to know exist and what they actually apply to. So this first part is, let's go through just the really simple setup of some of these types of taxes, and then we're going to get into how the rich stay richer, basically, and what the strategies they're doing, and how you guys who are thinking about starting this journey can adopt them. So my first one is here. For first-time investors, what are the main taxes in play? Because we have income tax on rent, capital gains tax when you sell, land tax, stamp duty, and sometimes GST. What does each one actually apply to? And the first one, if you need a reminder, is income tax on rent.
Yeah, so they're all different types of taxes, and they all have their own different types of legislation. So with income tax is tax as an individual. If you've got a property in your own personal name, it's the tax that you actually are levied after making a profit on the property. So for instance, if you've got rent coming in and you've got the expenses associated with the rent from this investment property, that net amount at the end, if it's a positive amount, you get taxed on that amount.
Right. So it's whatever you're positive on is what's taxed.
Correct.
So, and if you're negative,
and if you're negative, it's what they call negative gearing, which means that you're able to utilize that loss to offset other income in your tax return. For instance, salary and wages, interest, all those other types of income amounts, you're able to utilize that loss to offset all those type of income amounts.
Got you. So that's actually a really clear explanation that I've never heard before. So I like it. And now if we look into the capital gains tax, this is more when you sell.
Yeah.
So how does that actually operate?
So capital gains tax is a different type of tax. It's levied on the asset, and it's levied on the gain on that asset once you sell that asset. So for instance, if you bought a property for say $1 million, and you sold it for $1.5 million, that $500,000 is the capital gains taxable amount that will get taxed, which is the profit between your 1.5 sale value and the $1 million purchase value. Now, if you hold a property for more than 12 months, you actually will reduce that taxable value by half. So you actually get a 50% discount on that gain. So instead of it being taxed on $500,000 profit, you'll be taxed on the $250,000 profit.
Got you. So that's why they say to hang on to your properties
exactly for more than 12 months. Yes.
All right. And then you look at the land tax situation, which this is a racy topic at the moment because a lot of businesses that have work from home, I think the government's introduced land tax on having a home office.
Yep.
Explain that land tax concept to us.
So land tax is levied on investment properties. So just like capital gains tax is for property, that's capital gains tax is only levied on investment properties as well as land tax is. So land tax, the way that's applied is there are thresholds that are marginally increased depending on the unimproved value of that property. So what will happen is you'll get the state revenue office of that particular state. They'll review your investment properties and they'll have a look and they'll aggregate the total amount of all the values of the properties that you hold and work out a tax rate based on that value.
Right. So it's like grouping the value
together. It's grouping the value together and then they'll work out a tax based on the aggregated value and then they'll apply the tax to you.
Right.
Yeah. And what you can do is you're able to claim that land tax amount that you pay in your tax return as you go.
Okay. So this is the gears are turning in my head.
Yeah.
And then obviously we've got the GST component. Oh, sorry, no. Before that, stamp duty is the next one, which I think a lot of people know, which is effective. Like I'll let you explain it other than me.
Yeah. So stamp duty is another type of levy. It's a state-based tax as well. It's so what will happen is if you purchase a property, generally, if it's above 600,000, there'll be stamp duty applied. If it's your first home in Victoria, essentially, if it's less than 600,000, then you get an exemption for that stamp duty if it's your principal place of residence. So in that sense, what will happen is upon settlement, when you're actually purchasing the property, that stamp duty will be all encompassed with the property purchase value as well. You have to pay the property purchase value plus stamp duty amount.
Yep. Okay, makes sense.
Yeah.
So, and I'm glad you laid out that groundwork, right? Because I think the hardest part about this topic is a lot of people don't know what the taxes are, or they know and they've heard the terms, but they don't know how they work or how they're levied. So you've done a really good explanation about setting that foundation, right? So one topic that gets thrown around a lot as a strategy for tax, because you said it at the start, you have people that do negative gearing as a strategy for property, which I think is probably one of the oldest strategies that a lot of like traditional investors use. It's negative gearing properties for a gain. And then looking at the other side, people that are trying to positive gear or find assets that are going to give them that high return.
Yes.
But then they get upset when they have to pay tax on it. And it's this balance of what is the right kind of process, right? So in plain English, like when we look at negative gearing as a starting point, because this is the most traditional way people do investing, who actually benefits from it? And then is there a time where it doesn't help people?
So negative gearing has benefits in a tax situation. So what will happen is if you've got a high income, let's say, and you've got a lot of income that's taxable, well, that negative geared amount that you've essentially receive from this investment property, that'll help you in terms of reducing that tax because people that are earning a lot get taxed a lot. So this will effectively help you in that situation. It helps you less if you're a low income earner and having this type of investment because once you're below the tax-free threshold, let's say, for instance, you had a taxable income of $35,000.
Mm.
If after we take off those negative geared losses and you're below the tax-free threshold, which is $18,200, you're effectively getting no benefit at that point.
Right.
If your taxable income falls below that. So if you're earning high income amounts, then it works well, even medium to high income levels. And also it allows you to be able to utilize those losses for other types of income, as we were saying before as well.
Yeah.
So, yeah.
So it's interesting to me because like it gets thrown around so much like, oh, I'm going to negative gear. Do you have clients that have had just the same setup for so many years that then you get their portfolio for the first time and you go, why are we doing this?
Yeah, look, the thing is with negative gearing, it shouldn't be your sole focus in terms of trying to get tax benefits. You should really look at the type of property that you're purchasing and making sure that it's going to provide you with growth, wealth creation. And then what the negative gearing side should just be the icing on the cake. It shouldn't be the cake itself.
So it's not like that upfront strategy. It's like, what asset are you buying?
Exactly.
That's going to give you that perfect strategy.
Correct. And there's also different types of entities that you can purchase this asset through.
Yeah,
and
that's right.
I guess with that, you actually get some benefits through negative gearing, or you don't, depending on what type of entity you purchase the property through, whether it's in your own personal name, whether it's through a company, whether it's through a trust, or whether it's through a self-managed super fund. They all have different pros and cons.
Right. So when you're sitting down with your clients and like how much of a benefit is it when you get someone early who hasn't invested yet? So that maybe they have a principal place of residence, let's say, but they want to start this investment journey. Do you kind of see that as like the best case scenario for you because you then can actually set up all of their wealth creation tools from the start?
Yes. So if they've got, say, their own principal place,
yeah,
and now they want to look to expanding on that portfolio as such, we'll look to see whether, depending on their circumstance, like they may be a business owner, which they may not want to take any possible litigation risk in their business.
True.
And so they may want to purchase this next investment property in another type of entity. It may be through a trust, for instance, which gives you some level of asset protection there. So, or they may want to buy it in their partner's name rather than buy it in their own personal name. So there are different types of things that we look at to see their situation, like how are they employed currently, to see are they an employee or are they actually self-employed. We'll look to see in terms of, what the values are of these assets and see if they want to purchase, well, I guess, how much can they really borrow? What values can they use? Do they have the cash available to be able to buy? And if they were to borrow, higher than 80% of the value of the property, what's the consequences of those things? They're all things that we consider before we actually look to say, well, this is how we should go about buying that next property.
Yeah, that makes sense. So because then you're setting up the groundwork really at the beginning. And it's probably the easiest point to start. It's like you're not having someone that's come in as a hot mess or like they've had some other dickhead accountant come in and stuff it all up.
That could happen too.
Well, and that's like my next question, right? On the reverse side, when you do get like clients that come to you who have had maybe they've had an experience elsewhere or like an account that didn't help them the way they wanted to, how hard is it to then get that portfolio back on a positive performance or, with the right strategy in place?
It can be difficult. So there may be situations where, a client may come to us in a financially difficult situation, and it may be situations where they may need to transfer properties to different people.
Yeah.
So different family members, or it might go to another complete different entity, or they may have tax liabilities. And there's also a balance between, well, they've got to pay the taxes, obviously, but then also they've got the mortgage. Do they have the cash flow necessary to be able to fund all these things at the same time? So there's a lot of things to really discuss, and they all differ depending on the type of client that comes to us.
And I think, one of these things that I wanted to get into, right, is a lot of our listeners are tuning in because they're either starting their investment journey or they've got one investment property and they want to know how to, create this wealth machine that we always say rich people, and we go far out, like they just use the government's money and they use tax as an offset, and that's their strategy and that's how they keep getting richer. How true is that statement, that that's their method to the madness?
The first point would be to try and build up an asset base that allows for investments to be coming through in terms of incomes, to be at a way where they're passive. You're not really trying to work too hard to try and increase the values or, do certain types of things to try and improve it. So this way, for instance, you might buy a property that's in a really good location.
Yeah.
Now that obviously it differs in terms of values and it differs in terms of growth rates. So we look at those things to say, well, how are we going to best manage this client? Firstly, we have to try and get them with a buyer's agent or give them the right tools to be able to purchase these types of properties in a good way that's going to allow for these things. And obviously, the ultimate position people want to be in is, they want to work less and still trying to earn some passive income.
Yeah, well, that's the dream for a lot of people.
That's the ultimate dream. And so, tax minimization strategies, they're all there to be utilized.
Yeah.
There's nothing wrong with minimizing your taxes through legal means, but it's a way of also being able to discuss with your tax accountant to be able to try and find these ways to better yourself and obviously achieve your objectives.
Yeah, and that makes complete sense, because then I'm looking at this from, which I always hear about, is the depreciation, is a big silent deduction that I don't think a lot of people kind of talk about. Can you explain to us what it is and when is it worth getting a schedule? How do new builds versus older properties compare in this scenario?
Yeah. So what depreciation is it's essentially a deduction for you that you can offset against your rental income for all the fixtures and fittings in the investment property that you've got, and also the building structure in itself.
Right.
So you're able to claim that every year. So the actual structure of a property, you can actually claim over 40 years.
Wow.
Which is 2.5% a year. So it also depends, though, on how old the property is. Now, if the property is more than 40 years old, well, that's already gone.
Yeah.
It's already been depreciated. But if it's a newly built property, well, then if you engage a quantity surveyor, what they will do, they will go around the property and actually survey the entire property from all the fixtures, everything that's inside the property, the actual formation of the building, how that's all constructed, and they'll give you a report which costs about $550 roughly to about $770 depending on who you engage, and that cost also is tax deductible, so you can claim the cost of the report, and it'll give you an itemized year-to-year breakdown of what depreciation you can claim from all the fixtures and fittings, like, for instance, your hot water systems, etc., all those, the curtains, the carpets, etc., and the construction itself. So that definitely helps, especially on new builds, because you can claim a lot of depreciation in those first few years.
Oh, 100%. I think that's something that a lot of people don't realize, because can you do that for your own home, or is that just your investment properties?
It's just for investment.
Yeah, that's one of the questions we had from a listener, and I'm like, I'll double check.
No, it's just for investments. So, it's definitely worth engaging a quantity surveyor.
Yeah.
Especially if you're buying a property that's less than 40 years old, and also if the property is 40 years old, there may have been renovations that have been undertaken on this property.
Yep.
So even if you do engage a quantity surveyor, they will still work out how much depreciation they can claim on these newly renovated fixtures and fittings and capital works and things that have happened over the course of these renovations. So it's definitely worthwhile getting the report. And I think a lot of people actually miss out on these depreciation deductions because nobody's actually told them.
Yeah, that's right.
And I've noticed this a lot. Like, for instance, we may get some clients coming in for the first time and we've asked them, do you have a depreciation report? And they just say, no one told us even what that is. Definitely engage a quantity surveyor and pay for the report, and it'll definitely be worth your time.
So, and because when we're looking at all these components, right, the overarching thing is obviously we have starting a portfolio, you can purchase a certain asset, and then your accountant works with you for the best strategy for that asset. right?
Yep.
That's one part. Then you've got the people that have existing portfolios. They're gaining wealth, and they've got an accountant like yourself who's helping them manage that wealth and those kind of like tools to get, ahead, basically, of their portfolio. So in terms of like looking at main residence, right? So we're talking about a principal place of residence. How does the home you live in exemption work? Like in terms of like, what's the simplest version of move out and rent it rules that people hear about?
Yep. So the main residence exemption, what that is if you live in your own principal place of residence and that's your permanent place of abode, then you'll get an exemption when you sell that property, right? It's not your investment property. It's the home that you actually reside in and live in. When you sell that property, it's tax-free, regardless how much of a gain you made. If you bought it for $1 million, you made $3 million, that $2 million difference in gain that you made will be an exemption in terms of being taxed. There won't be any tax applied. In terms of the 6-year rule, what that is the ATO allows for you to initially move into a property and subsequently, if you move out, you're able to rent that property out for 6 years, right? And when you sell that property, you're able to get a tax exemption even though you rented it out after you've moved out.
Oh, but you're keeping it for 6 years as a rental.
Yeah, correct.
Got it.
Now, what happens is if you move back into that property, it restarts that 6-year process again.
Gotcha.
So essentially, you can move back in for another 12 months and then rent it out for a further 6. And when you sell it, then that should be tax-free. Now, it also depends on how long you've also kept that property as an investment property as well. So if you've moved in initially and then you've rented it out for, say, 10 years, well, then there's going to be a proportionate amount to say, actually, well, how much is actually taxable and what's tax-free because you've rented it out for more than that 6-year period.
So is it kind of the idea is like you have to get to the 6 years and at that point you would be considering selling on whatever you want to do?
There's a possibility of that as well, or to restart the process by moving in again and then restarting that process again. So that will also allow you to generate income from that time. In that 6 years that you've been renting the property out, you can generate some income, get some tax deductions. For instance, you can claim your council rates, repairs and maintenance on the property, water expenses, insurance costs, land tax, all those things associated with renting the property out. You can claim all those tax deductions after you've moved out. And then when you sell, depending on the time frame, we have to look at the time frames in terms of how long it's been rented out versus how long you've actually lived in this property and when that occurred in order for us to work out how much tax will be applied, if any.
Gosh, there's so much to it though. Like, and this is why I feel like having an accountant do it. It's like so much better.
Yeah, because there is a lot to consider.
Yeah, because like when you're getting tax time, I can imagine that's the worst time of year for you.
It's always the worst time of year.
So, when should people like ideally be like, because you work with them throughout their time, right? So when are the biggest audit times? Like, do you have to take an audit before tax time only, or are you kind of like evaluating portfolios throughout that 12 months?
Look, because we discuss things with our clients constantly, we're always reviewing things. And I guess when it comes time, for lodgement date and also tax time, that's when we'll definitely look into people's situations, especially when we know that there's going to be significant changes. We'll definitely be looking into those things before the end of the financial year to give them some guidance or strategies in terms of what they can do to try and, better their position. So in saying that, we'll be looking at it consistently and also at the end of the year. So there are, peaks and troughs in terms of discussion points that we have with them.
So you're not kind of like, leaving it all to the last minute where people then start trying to spend up all their money before end of tax and you're like, what are you doing?
Because that'll just build up the stress levels too.
That's what I mean. I'm like, I feel like a lot of people, like especially business owners, like they'll go, just get it in. Like, are we doing that project? Spend the 30K we budgeted for 6 months. We're going to spend it all now.
I know. It's like, oh, you can't.
It's like, stop.
Or you can. You might be able to. So yes, it's all the things that we have a chat about.
And then you got to work with them. So it makes sense. And like this leads perfectly into like the next part, because now that we kind of have like all the puzzle pieces, right? So we've got all these tax components. Now let's talk about how these smart investors arrange them legally. And I say that because sometimes it seems like it's illegal, to reduce what they pay without getting cute with the ATO. So for this next part, I want to talk about how smart and rich investors legally minimize tax. So what are your top 3 legal strategies that you see sophisticated investors use to reduce tax on property income and gains?
So first of all, it would be the type of structure that they purchase these assets through, whether it's property, whether it's shares, different type of investments. We'll first look on the sophisticated investors will definitely discuss with us in terms of what type of structure they would want to purchase this type of investment through. It may be individually, it may be through a company, maybe through a trust, partnership, or a self-managed super fund. And like I said before, they've all got their own pros and cons. So they're definitely one thing that we'll look into, and also what these sophisticated investors, they'll want to know these things. They'll want to know, well, if I buy it in my personal name, what's the benefit to me? And usually sophisticated investors in terms of their terms, are sophisticated investors that earn more than $250,000 a year. But if you're not earning $250,000, you can still be a sophisticated investor as long as you put these practices in place. So if you buy a property in your individual name, well, you'll get the negative gearing benefits if it is negatively geared, meaning your expenses outweigh your income from the property. You can buy different types of properties. You can buy residential, you can buy commercial properties as well. So commercial properties could be office buildings, commercial properties such as like factories, etc. And they've all got their own pros and cons as well. So depending on the type of market growth rates as well, like you may see that commercial properties may be outweighing residential type of investments at any given point. There may be better tax advantages to doing one over the other. And so, buying it through a self-managed super fund, for instance, is another option that you can actually have, where, you can buy a property in a self-managed super fund, both residential and commercial. You have the option. You can also borrow through it. You can borrow through a self-managed super fund. And when you become at pension phase, essentially at retirement phase, well, then you can sell that property and it can be a tax-free property when you sell.
Yeah, because this is like what you're explaining, which actually led into my next questions of these structures, right? It's owning it in your name versus a trust versus a company versus, the SMSF.
Yeah.
The trust one is interesting though, because it's a self-managed super fund. So like in simple terms, and correct me if I'm wrong, it's basically instead of you having like your super sit with one of like Australian super fund or whichever super fund exists, you're basically opting to manage it yourself. But the way the government allows you to do that is you can buy property and buy certain things that allow you to aid your retirement. So it has to be for your retirement. You can't just buy an investment property and get rid of it.
That's right. It's got to meet what they call the sole purpose test, which means that it's got to be for your retirement. That's you can't buy a property through your self-managed super fund and go and live in there.
Yeah.
It's got to be solely for that reason. Now, if you've got, for instance, a business, you're able to buy a commercial premises through your self-managed super fund, and you can also lease that out to your business that you're running. For instance, you want to buy a salon and you want to buy a hair salon and you want to utilize the self-managed super fund to make the purchase. Well, that can be leased out to your hairdressing salon company.
Yeah.
And that's another way that you can do. And obviously your hairdressing salon company will pay the rent to the self-managed super fund. They're different types of strategies that, you can have as well. So other types of entities you can buy a property through, for instance, would be, say, a company. Now, a company is different, and because the company is governed by ASIC, which is the regulator, the Australian Securities and Investments Commission. Now, buying property through a company is a little bit restricted. So firstly, you don't get that 50% capital gains tax discount to a company. So remember when we spoke about how if your property is $1 million and it goes up to 1.5 and you'll get that 50% discount? Well, you don't get that discounting in a company. You'll be taxed on the full value of that profit.
Oh, wow.
So, and also the other thing is if you do buy a property through a company and it's taxed, well, if you make a gain, there's also rules around how you get money out of a company. So you can't just make money through a company and just decide to rip the money out of the company and that's yours now. There are tax implications, what they call Division 7A legislation, which actually prevents a shareholder of that company just pulling money out for personal reasons. So for instance, if you made money through the company on this property purchase and now you want to put that gain in your personal offset account to offset your
other stuff,
your own home loan for your own house that you live in, well, the company legislation restricts that.
Right.
So what you need to do is the money is going to be funneled out of that company through other means. They've got to be done through wages or dividends, which all has tax applied to them.
Yep.
So that's where it gets a little bit restricted and a little bit tricky to purchase to a company. Now, if you purchase a property through, say, a trust, there are advantages of purchasing property through trusts. For instance, because every trust has what they call a trustee. Now, a trustee is the administrator of that trust. That trustee can be either an individual or it can be a company or it can be a type of organization. Now, what they do is they administer the trust, and based on the deed, which is the governing rules of this trust, those governing rules they have to abide by and make sure they execute what the trust deed says that you must do and administer it accordingly. So in saying that, when you purchase a property through a trust, there are advantages of asset protection because let's say, for instance, if that trustee is actually a company, for instance, and it owns nothing in there, then you have that benefit of the safety of that property being left in the trust as opposed to in your personal name and it being up for grabs, for instance, if in the event of, say, litigation.
Yeah, so this is where it becomes like a topic that I think a lot of people maybe know a little bit about, but not enough. It's when you're when you've got people that say they're trust fund kids, right? And they've got all these assets under this trust and this family trust comes in. Basically, that's a form of protection, right? For, like you said, when you're if someone decides to sue you personally, but let's say your house lives in a trust, that's a form of protection for that asset, isn't it? So they can't, in a way, come after that asset, or not really, or not technically.
Well, look, there is a lesser risk by putting it through a trust as opposed to you personally, because if there is a company acting as a trustee of this trust and you're the director, sole director, well, I guess what can happen is within the rules of a company, they are able to lift what they call a corporate veil, which is essentially a veil that separates the company from the director itself. They could lift that and potentially come to you for personal guarantees, for instance. So there's a lesser risk of that. But the other side, there's also a negative side to those things as well, whereby, let's say, for instance, you've got a negatively geared property and you've got $15,000 of negatively geared losses, let's say, for instance, in this trust. Well, unfortunately, when you have losses in a trust, the trust has to distribute income every year to its beneficiaries. The beneficiaries are the underlying people underneath the trust that receive income distributions from this trust every year. It must happen. The trust must distribute this income and it must go to these individuals. So what happens is if there's a loss at the trust level, that loss gets quarantined at the trust level. You can't actually distribute losses out to the individuals and then them get a benefit individually. So it just stays in the trust. The only way we'll offset these the trust losses is if there's other income coming in through the trust. So it's quite complicated, but that's sort of the essence of what it is, trying in simple terms.
And I guess when is it appropriate for these? Like, if you had a person that came in and said, like, I've got a house that I've purchased, like my own principal place. I've also got an investment. How do you advise on the best structure that they should adopt, if it should be through a trust, through SMSF, or if it should be purchased individually or through a company? Like, what quantifies your decision making there?
So firstly, their income levels, how much they're earning. So we'll look at that. We'll also look to see if they've got any other assets within their own portfolios. Look to see whether they are self-employed, whether there's actual risk to them purchasing it in, their own names, etc. And look to see what's going to be obviously the best in terms of tax minimization. We'll look to see which avenue is best for them to be able to utilize this entire scenario to get the best tax outcome overall, and also to build up their wealth creation situation. So we want to make sure that on top of getting benefits through tax, we want to make sure that they can also increase their equity within their investments.
That makes sense. And it's just assessing, like, what is the best tool for that. So it's like you basically get that full picture and go, here are your options.
Yeah.
And here's why they could benefit you or not benefit
exactly.
you. And this is where those strategies come in. Like, I'm just putting the puzzles together, right? Yeah. And it's like, this is where the next strategy comes in of, okay, this asset could be perfect for negative gearing because you spend way more than you're making on it.
Yeah.
But this one here could be good for tax minimization in these certain channels.
Yes.
And this is how you play that game.
Exactly.
And so all of it's just a balancing act. Like, I can't imagine someone trying to do this themselves.
Yeah. That's why it does get tricky. And I guess every client situation is different. So we have to take all that into account when we look at things. And so when we have that discussion, we'll look at that. And then, at least the client then is satisfied with the fact that we've analyzed all of this.
Yeah.
And they're confident in the purchase that they make.
Yeah, because that's the last thing you want is like to advise someone and then they're just like, cool, I'll go with what you say. And then they have no idea how it works or operates, because then they don't know what to tell you either.
That's right. And it's all about education. Like, we have to educate the client as to the differences, what works well, what won't work well, and why we're doing these things, and explaining it to them in simple terms.
Yeah.
So that we can at least get them to feel comfortable. This is like the biggest purchase they're going to make.
Yeah.
They're like, there could be an investment property, could be their own house. We want to make sure that it's right and put them to the relevant people as well. There could be brokers, buyers agents, lawyers. There's so many people involved in the process, as well as the accountant. And so we want to utilize all these channels to make sure that, they're getting the best outcome.
And it kind of leads me to that, you mentioned passive income earlier, that everyone is chasing this passive income because it means that you can then move around and do your own thing. You don't have to work, but you can work, kind of thing.
Yeah.
What's kind of the structure you see a lot of these savvier investors that they've adopted in like their structures and portfolios that allow them to have that passive income? Is there like a perfect asset or like a perfect structure that kind of always works?
There's never a perfect asset or a perfect structure.
Yeah.
It's mainly looking at, in terms of the asset, looking at the type of asset, and in terms of what it allows based on the current market situation to be able to allow you to receive in terms of an income or equity increase in terms of the value of that asset. In terms of the types of structure, there's never a perfect structure, but there is the best one for your circumstance.
Yeah.
So we've only got limitations in terms of the type of structures that we're able to use, but we'll have a look to see what type of structure would definitely benefit the client more so than others.
Yep. So then you've got these guys that are out on the weekends playing golf, sipping champagne, and their assets are doing the work for them.
Yeah, correct.
So that's the dream, I think, for a lot of people, right?
It is absolutely.
Just to relax or like do those things you want to do.
Yeah, you want to go for a walk with your dog, you want to go play golf, you want to be able to do all those things and not have all these worries in the back of your mind as to, is my income generation occurring from the properties? Have I even bought the right house? Have I not? All those things you could be, playing up in your mind. So
that's so true. Yeah. Because the other thing is like, I think people often misunderstand the fact that when people have passive income, they don't necessarily have a 9-to-5 job anymore. Like that was the whole point.
Yeah.
Is that what you find as well with your clients, that a lot of them have stepped away from that 9-to-5 and maybe they've started businesses or side hustles instead, just because they've got the income to do it?
Yeah, or it depends on the amount of income that's received. Some of them transition out. So, they may decide to purchase different types of assets, shares or property, etc. And over time, they can see themselves starting to wean their way out of their 9-to-5 and working their way to becoming self-employed. And there may be some time lag between that period. But in that time as well, they're also trying to save some money, trying to utilize other type of investments they may have to be able to buy other assets. So this is all, it's a stepping stone, and these things will take time. It'll never just happen in a day. And people just have to be also patient and also utilize what opportunities there are in the market, as well as utilizing potential legislation and tax minimization strategies, as well as speaking to professionals about what they think would be the right fit.
Yeah, and that makes complete sense, because I'm looking at the timing wise, like what you said, decisions like that people make before June 30 or before they buy or sell. Like, what are some of those things that, these, I guess, savvier investors make before June 30 or before they buy or sell, or like to move the tax needle the most?
Yeah. So some of them, well, if they don't already have a quantity surveyor depreciation report, the savvy ones would go out and get one pretty soon, because they can go back in time and work out depreciation that hasn't also been claimed in prior years.
Right.
So it's better to get that done before 30 June. Also, if there is interest, if there is reserves in terms of cash, they can prepay interest for the next 12 months in advance before 30 June to claim that interest now rather than waiting till next year.
Oh, wow.
But that's if you've got the funds to do it. And other types of situations to actually utilize, these tax minimization strategies as well would be, for instance, speaking to your professional would be first, and also to look at making a log of the repairs and maintenance that you've had on these properties, and being able to see in terms of what's renovations have taken place, if there has been any. Those are the sorts of things that you'll probably look at.
Yeah, that makes sense. And that's why I wanted to ask that question. I'm like, how much of a rush do we see?
Yes.
And I want to talk about cash flow versus tax. What do you say to someone chasing deductions while ignoring whether the asset itself is any good?
So you'd want to make sure that you're getting a cash flow positive return. Yes, there may be tax implications. You may have to pay tax on it, but at least you know that at the end of after paying all these expenses, that there's money that you've made on it, as well as the value of the property has been going up too. It's no good spending all this money and just getting a tax refund at the end if your property is consistently making losses and also not going up in value or staying stagnant. So you want your overall wealth position to increase to be able to do other things. So, for instance, purchasing that second property. If it's not doing those things, that increase in value or stagnation, for instance, may not allow you to buy that next one that you want, or depleting your cash reserves by having to fund extra amounts into this property. For instance, poorly designed properties or poorly constructed properties that you need to constantly put money into for repairs and maintenance expenses. Yeah, you may get a deduction for it, but at the same time, though, you're looking at it saying, well, how good is this type of investment that we've made if there's a lot of problems going on too? So it's always best to consider the type of asset and how much money it's going to make you, rather than the actual deduction you're going to receive.
Yes, there's no point trying to spend as much as you can just to do negative gearing.
Exactly.
When the asset's not moving on in terms of growth.
Exactly.
And then that's where you could almost look at, is that worth selling or not? Or do you change strategy at that point and go, All right, what can we do with this asset? It's a bit dead.
Exactly. Like, for instance, a lot of people, over the last probably 10 years, they've bought apartments and they've gone down in value.
Yep.
And so, we've seen that through people buying apartments through the self-managed super funds. And they want that as well for their retirement planning, but they haven't necessarily gone up in value. So we see those things, or they may be in an apartment, there may be, for instance, cladding issues that you might...
Every apartment.
that the owner needs to put more money into. And at the same time, there are also limitations in terms of people's borrowing capacities and their income that allows them to buy a better property, for instance, one that's got land on it, possibly a townhouse or a freehold property. But it may be a starting position, buying an apartment and moving on, but at the same time, there's so many things to work through to make sure that they're buying the right home. And for first home buyers, it's difficult. It's not easy for them to firstly get into the market and also buy that property that's going to give them sufficient amount of growth. And I know, at the moment they have released different types of guarantees, etc.
Yeah.
But still, you've got to work with the current market and see what you can buy that's going to give you the best value add.
No, it makes complete sense, like the way you've put it there. And let's apply that to real life, right? These concepts. There's 3 quick scenarios that listeners hit all the time. These are ones that actually you guys have submitted to us, so thank you for sending them in. They want to be kept anonymous because I think it's their personal situation. But we want to know how you would approach them. Mm-hmm. All right, so this quick scenario, let's apply these rules that we're learning about. Scenario 1, this person said, I've bought a 10-year-old investment unit. The rent is $520 per week, principal and interest loan. No depreciation schedule yet. What are the 3 tax moves you'd check for me this year?
Firstly, you should go and probably get a quantity surveyor's report, regardless of the fact that it's 10 years old.
Mm-hmm.
The quantity surveyor can go back from the time that it was a rental property, if it was a rental property, and work the depreciation from that point onwards. Another thing would be to also look in terms of what renovations have been made on that property, and also looking at your loan situation. Now, it's principal and interest, but would it be another situation to have it interest only if it's going to be, if it's going to allow for more cash reserves for you, or if you're going to be able to claim more interest deductions as well?
That's true.
So they're probably the 3 main things that we'd probably look at.
All right, well answered. Hope that answered your question. Thank you for submitting it, mystery person A. And then this next one said, I live in my townhouse, or I've lived in my townhouse for 3 years, moved out and then rented it for 4, and now I'm thinking of selling. What basic capital gains tax questions do you want answered before I list it?
So I'd want to know, did they move in initially? Firstly, to see whether this 6-year exemption rule is going to apply. Also, work out in what entity that they're actually purchased the property through, and also to see in terms of the value that they purchased and what it's currently sitting at in terms of a market valuation, to see whether they actually are going to get a capital gains discount or not.
Yeah,
and see if they've held the property for more than 12 months. Those are the sorts of things that we'll look at to see.
Yeah, that makes sense, because I think it's like these scenarios, why I like that people submitted them is I did a call out last week and I said, ask me questions about tax that you don't know about. And I said, give me scenarios. And they've come back with some really interesting ones. I've got one more for you from this group of people who came back. But I like the way you're answering these, because it seems so simple in terms of checks, but this is what you do with an accountant, right? This is not stuff that you would just go on the internet and go, okay, cool, let me check this.
ChatGPT
I love AI, but fuck, it's rough.
It's got some good stuff, but as well, you can't always rely on it. That's the thing.
ChatGPT is good with your profession because you're the professional and you can moderate whether that's right or wrong.
Exactly.
Right? But when you're an average person going, should I buy this house? And you just put in the listing, it's like, listen.
Yeah. There's so many, you haven't probably put in all the factors of your life into the question first to get the right answer.
It's the same with tax, I'd imagine. It's like you haven't told it exactly how much it's gained, how much it's like lost, what your situation is. So just use it sparingly. This is why I say use a professional.
Yeah.
ChatGPT can explain concepts really well, but it's not going to personalize or tailor it to make sure you've got the right strategy.
That's right.
And it's not going to ask you the questions. So,
no.
This last one is I've got 130,000 in savings. I've got a combined income of 200,000, renting happily. Should I buy my own home first or an investment property? And what are the tax pros and cons that actually push that decision? That's a really good one. Yeah. What should you start with? Because a lot of people are weighing this up at the moment.
Yeah. So they're currently renting, which means obviously they're not putting any money into any type of investment right now that's causing them to increase their wealth position. So look at it in terms of the type of property that they want to buy, whether it's an investment property and continue to rent at $520 a week or buy their own home. Well, at a first point, it would probably make sense to buy their own home first, just because of the fact that there are benefits such as the main residence exemption when they sell the property. It allows them also to increase the value of their wealth position by waiting for that property to go up in value as well. If they went to purchase a investment property, well, they'll get tax benefits there through possible negative gearing, depending on the type of property, but they're also outlaying rent at the same time. So there may have to be funding the investment with a top-up amount based on the rent that comes in and the repayments on that loan, as well as funding the rent side of things as well in the house that they currently live in. So I think from a first point, it would be best to probably start off just looking to buy your own home, owner-occupy, be tax-free, to be your home. And yeah, you can just decide to just put the money towards the repayments and try and knock the loan down.
Because then in the future, like if you hang on to that for like 3 to 5 years, then you're looking at like you could use your equity to invest instead.
Exactly.
And it's not like you're outlaying savings, physical savings that you have. It's like you've let the asset work for you for the last few years.
Yep. Exactly.
Yeah. No, it makes complete sense. Thank you for answering those questions, and thank you for those who submitted them.
Thank you, guys.
Yeah, but we're not going to let you go that easy, because now it's time for our fan favorite segment. It's the Reddit segment. So these are real posts, real pain points from other people who are just on the internet. We're going to keep them simple and fixable. So we're going to do more scenarios, because the best way I thought to break down this topic was to actually throw real scenarios at you and get you to.
It's always better when they're real.
Yeah, because I can ask all the questions in the world, but then, when I'm a listener trying to picture it, I'm like, I still don't get it.
Yeah, these are real life problems
it's like
that people have. So
that's what I mean. I'm like, this is real shit. So let's get into it.
Let's do it.
So, like I said, it's the fan favorite segment. Thank you guys for always tuning into this part. This is where people ask the questions that they're too scared to ask their accountant, or they crowdsource advice from strangers on the internet who may or may not have ever done a tax return in their life. So, break this down with me. This first post is about this person's titled it "A Duplex and Land Tax Threshold Confusion." That's how they've written it. The summary. So this original poster has said they are considering buying an older duplex on 2 titles in New South Wales. They want to live in one half and rent out the other, but they're confused whether land tax will apply, because they've heard if it's on 2 titles, you're instantly over the threshold. And they're trying to figure out if the primary residence still exempts parts of it.
Yes. So in New South Wales, there's the threshold for land tax to apply for a property that's an investment property is about just under $1.1 million.
Right.
And what the State Revenue Office of New South Wales would do, they would look, as I said before, they'll look at the unimproved value of the investment property and apply the rate of tax on the amount that's above the $1 million on that land value.
Got it.
So it won't apply to the one that they live in. It'll apply to the other one, because there's 2 titles.
Yeah.
And so they're going to look at it to say, well, that's one investment property that you own. We'll apply the land tax on that one alone and not on the main residence one.
Got you. So
if it was on one title, that'd be different.
Also, what if it was one title, but
Yeah.
obviously like two separate, dwellings on the one
Yes.
title, and they wanted to occupy one? What happens in that scenario? How would they be taxed?
Well, there would be a proportionate amount.
Oh, okay.
Yeah. So in this way, the fact that they've segregated two separate titles, one of them's an investment property, well, then that one will be a taxable one, and the main residence will
so
be
they're
their own
treated
exempt
separately.
one. Yeah.
Yep.
And so there's from the 1.08% roughly, $1.7 million threshold to about $6.7 million in New South Wales, there's one rate of tax. And then above the $6.7 million in New South Wales, there's a premium levy of tax after that point in New South Wales for land tax.
Yeah, interesting.
Yeah.
Okay. Interesting. So then when someone says, or like when someone buys a duplex with two titles, one they'll live in, one they'll rent out, in like this scenario here, does the principal place of residence exemption cover the whole block, or you're saying it's literally just the title itself?
Yeah, it'll be the title.
Right. Yeah. So then
it won't be the whole. It'll just be the portion that they live in.
Yeah. Okay. Yeah. So I'm with you. So then what's the simplest way for someone to check their exact land tax exposure before they buy something like that?
So what you do is there's a calculators online that you can check to see what the value of that land would be, and also to calculate what the levy would be as well. So if they punch that number into the calculator, they would get a land tax value to see whether they would actually have it levied on that property and how much it would be.
Right. And do you rely on those calculators as well, like yourselves, like when you're doing all these calculations?
We do the calculator. We'd go on the State Revenue Office website and work out what those things are. So I guess it's the most accurate.
Well, that's what I was going to ask.
From the State Revenue Office.
Yeah, cool. So that's just a little tip for you guys, is use the one from the State Revenue Offices, not the generic ones you find on random websites.
Yeah, exactly.
This is what the accountants use. So that'll
correct.
just already help you.
Yeah. Well, it's a government calculator, so shouldn't be wrong.
Imagine. And this next one is they're running, this is another poster from the Oz Property Chat, and they have titled it "Running a Business from Home Plus Capital Gains Nightmare." So here's the summary. This original poster, or I'll call them an OP, he runs a small business from home. Now, in terms of my notes that are now covered for some reason, okay, so the ATO says that if they claim a portion of their home as a place of business, they could lose part of the capital gains main residence exemption. They're freaking out because they thought work from home expenses were harmless. Now they're worried that they've basically created a taxable asset. So for these listeners who are working from home, what's the difference between home office expenses and declaring your home as a place of business?
So if you're an employee, let's say, and you're working from the kitchen table and you're claiming deductions for home office expenses such as telephone, internet, some utilities bills, well, then those running costs will deem you at that point to be somebody that's not operating a business at the moment. But if you have actually separated a section of your house, for instance, to turn it into a hairdressing salon, or a clinic or an office that you actually having clients come into, and you've got signage there and people can see that it's actually a separate section of the house that's running as a business, well, then when most people will claim, for instance, some of the interest costs on their mortgages or the rent costs that they may be paying for, occupancy costs, for instance, council rates as well. Well, then that's when the ATO at that point will deem the house or that section of the house to be a principal place of business. And so when you decide to sell that house, even if it is your main residence, and usually you should get the main residence exemption in full, if there is a portion of the house that is a business section, well, then you'll have to carve that section out of the calculation, and that section will be a taxable proportion.
Got you.
When you sell. So it won't be fully exempt. You'll have to actually work out what that section is. The percentage, like could be 20% of the house, could be principal place of business, and then 20% of it will be taxable to gain.
Yeah, got you. So the difference between like working from home is like you're utilizing your utilities
Yeah.
to be able to work from home.
Yeah.
And that's taxable.
Yeah, correct. And if you've got, if you're showing that you've got an actual business venture happening within, if you're operating a clinic like a medical clinic, or you've got a hairdressing salon or those types of things, and you can definitively say that there's a business operating out of there, well then yes, that will have to be carved out of the calculation. But if you're just working from home, say twice a week, and you're claiming the shortcut method of hours worked from home per week, for instance, you might work 2 days a week from home, and that will be calculated at 70 cents per hour as the claim, which is the shortcut method. So there's a difference, and the ATO looks at that differently. So yeah, it depends on what they've actually done with the house. Have they actually separated it and made it a business place, or if it's just him just working a couple of days a week from home, and that's it.
That makes sense. So then I guess how can claiming the wrong thing in this case accidentally wipe out part of your main residence capital gains exemption?
Yeah. So if they're claiming occupancy costs, for instance, the rent they're paying, interest on the property that they live in, council rates, those types of things are meant for investment properties. That's claimable, not for main residence properties. Once you're putting them through and claiming those types of investments, well, then the ATO is going to start deeming that to be an investment and a taxable type property.
Ah, got it. So it's like you have to be really careful with how you do it.
Yeah.
And is that something that you obviously can assist your clients with going, like, don't do this?
Yes, exactly.
Or if you're going to do this, then this is going to happen.
Yeah. And if we know that they're not running a business from that premises, we're not going to be claiming those things that are occupancy costs.
Yeah. Okay.
Yeah.
Makes sense. Yeah. It's like you had a shower.
Yeah,
claim.
Exactly.
And I guess the last question for this one is, what's your advice to someone who wants to claim home-based deductions without accidentally turning their house into a taxable business premises?
Well, the simplest, most shortcut method to that is actually using the shortcut method that the ATO says. And that is just working out the number of hours that you work from home, having a log of that, keeping a record, working that out over the number of weeks that you've spent working for that year, could be 48 working weeks, and multiplying that at 70 cents. And then that will be your claim. And that will capture, that shortcut method will capture your internet, your mobile costs, and other type of costs as well.
Yeah, so and that's why they call it the shortcut.
Exactly. That's the simplest way to not have that mistake happen, where they can deem that property to be a business.
Yeah, because then the alternative is like counting every single cost.
Yeah, correct.
Yeah,
correct.
Got you. And I've got this next scenario here. So this is the last scenario I'll put you through the ring up. I like this one's interesting. They've asked whether removing negative gearing would actually lower property prices or whether the impact is overstated. So the whole thread is basically people debating tax policy like they're on Sky News after 3 Red Bulls. So when people talk about removing negative gearing, what does that actually mean for everyday investors?
Well, going back to the Bill Shorten and Scott Morrison election from a few years back now, I think this is one of the policies that Bill Shorten at the time was proposing, to say they wanted to get rid of negative gearing. And so I guess that's what lost him the election at that time, was a lot of people that wanted to invest in investment properties were turned off by the fact that they won't get that benefit of negative gearing. So in terms of what that would do to the actual market itself, from some of the things that I've read, they've stated that it won't cause an entire crash. There'll be a marginal correction in the actual property values. From what I've seen and read, they say to between 2 to 3% differences. But I can't foresee that until it actually happens. But what that would do, though, it would channel people's interest in potentially different types of asset classes to invest rather than property. Given the fact that they may not get the benefit of negative gearing anymore, they may decide to think, well, we may invest elsewhere in a different type of asset class. For instance, I might want to put my funds in a share market now rather than buying an investment property. If I've got a really high income and I'm not getting any benefit tax-wise, well, then they may decide to invest in different ways. So buying shares and getting franking credits on those shares, which is a refundable a refundable refund that they can get or an offset, essentially on the taxes that are paid by the company for issuing those dividends to you as income.
Yeah.
So you get that as a tax rebate, essentially, of that 30%. That 30% is what the company is paid on their tax rate. It's 30% corporate tax rate. You'll get that as a rebate, so you don't get double taxed.
Got you. So, because that changes it, right? It's like in terms of like future clients who are thinking about negative gearing as a strategy, yep, okay, obviously they've got time to change that strategy. But the ones that are already doing this negative gearing shift, that, like you said, this is where the conversations start to come up of, do I just get rid of this asset?
Yeah, well, they might say to themselves, well, I can't really, it's causing me a loss every year, but I'm not really utilizing or getting any benefit.
That's right.
We don't know what the policy will be if they decide to abolish negative gearing. Now, they may allow those losses to be able to be utilized when you sell, to reduce possible capital gains in future. That may be a possibility. They will have to just see what happens at that point. Hopefully, they don't just say, well, you know, if you've made a loss for this year, well, you have to just forego the loss. There should be another benefit on the other side for foregoing this loss.
Yeah.
So let's just hope that the government's
going to complement
in some way. Otherwise, people might just see, well, if I'm just constantly making losses and getting no benefit on the other end, well, they may just be put off altogether. So these are the things that, you know, we've got to sort of look into, especially if election time and these types of things are coming up. People are aware of these types of policies and talk that goes on just before election time. And so people may be either waiting for post-election for these things to happen, or, they may just decide not to.
No, that makes that for me, I think these election talks, you always hear the promises, and then what comes out and it's like, whoa, far out.
Yeah,
didn't happen, like, of course.
That's right.
They've won and now I'm annoyed.
Yes.
It's like, I regret it. No, thank you for running us through that, because I feel like the way you answer these questions, and this is exactly why I said you were the perfect person to bring on this episode, putting it in real life and just going through these scenarios, these are all very like real people concerns that are going on out there. And I think tax is such a dense topic that people don't like talking about. They just kind of go, whatever, I'll just go do my tax return on the 30 June and shut up.
Exactly.
But it's like, no, like this is a big way to benefit. Like it determines a lot of stuff in terms of like your cash flow, how investors are investing, how wealthy, you know, manage their funding. So thank you for playing along with our little Reddit segment as usual.
No worries.
But I want to land this with clear next steps, right, for our listeners. So for these first-time-ish kind of investors who are listening today and want to, you know where they're at, let's give them something practical. If a listener plans to buy an investment in the next 90 days, what's one conversation they must have with their accountant before they do anything?
Well, firstly, they should really be seeing if they can afford this property. That's one thing. And it depends on what their income levels are, what their lifestyle factors are. Can they afford the property? I understand everyone wants to get in, but at the same time, once you're in, you don't want to be selling or having or being able to have a fire sale because you can't actually service this loan.
That's true.
So that's one of the things that we actually want to talk about, because people will go to their brokers and say, you know, we can borrow X amount, but that's fine. But at the same time, we've got to say, well, is this even affordable?
Yeah.
How is that going to work for you and your family and what your needs are? And is it going to put a real dent in your cash flow? So, and also the type of property as well that they want to buy. These are the sorts of conversations, especially that's the main thing that we'll look at.
Right. Yeah. So, and starting off a good portfolio always starts with like that planning, isn't it? So it's like you would actually run through with your clients, what assets are we looking at?
Yeah, definitely.
And then what kind of structure? So it's like we've got asset as one thing. It's like, are we buying units, commercial, residential, apartment, you know, house, or shares or any type of like whatever that kind of investment looks like. And then on top of that, you're looking at, are we buying it through an SMSF? Are we buying it through a company, yourself, or anyone else? So I like that you kind of have that structure, and it's becoming really clear to me, and I hope our listeners as well, that these are like the big broad things that need to be placed at the start of the journey, not in the middle where it's a friggin' mess.
That's right.
And then you're trying to piece it all together.
A good house is built off the back of good foundations.
Nice. I like it. And it's true.
It is true.
For these first timers, what's a simple yearly checklist to stay on top of deductions, records, and timing?
It'd be rental agent statements. So getting the yearly statements from the real estate agent. Also keeping a check of your home loan statements, your bank statements on the loan, seeing how much interest has been paid, keeping a log of repairs and maintenance on the property as well, making sure as well that you've got a quantity surveyor's depreciation report, those sorts of things as well, keeping a record of all your rates as well as, council, water rates, land tax as well, keeping a record of all these things to make it simplified when it comes to tax time.
Yeah, because I think that's the hardest part is having things organised. By the time you get to your accountant, it's like you treat your accountant like someone you see once a year.
That's right. And let us know when you've sold the property.
Oh, do you get that and people don't tell you?
Yeah, well, sometimes I find out after the fact. Like, let us know when you're thinking about doing it rather than just doing it and then saying, well, what's the capital gain? Like, how much tax do I have to pay now? Like, we would have told you that in advance if you just let us know.
Would have planned it out with you.
Yeah, exactly.
Because, oh, God.
They're the main things. It's just let us know when you want to do these things.
I think I can't believe we've already gone through our time. Like, far out. It goes so quick.
It surely does.
Yeah, I'm like, hang on, wait, maybe I have personal questions. Tell me about No, Daniel, thank you so much for your time today again.
Thank you.
And for coming back on, because I feel like this is going to be a really important episode that if we break this down the way we have today, I feel like a lot more people are going to feel a bit more comfortable about their approach. What's like a final thought that you want to leave our listeners with that are in the position of trying to assess what they're doing, and with their assets and how they can actually generate this path to wealth?
Give me a call.
Step one.
And just speak to your advisors, speak to your professionals. They're the people that you want to speak to in terms of trying to build up this next step for you.
Yeah.
They will go through what your objectives are and to get you to where you want to be. So it's always important to make sure you've got the guidance around you and to help you achieve those things.
Yeah, it all starts with that conversation of like, where do you want to be and how does your accountant make it happen?
That's right.
Daniel.
Or if they don't, just give me a call.
And if you have a shit accountant, it costs nothing to have a chat.
Exactly.
I'm always going to bang on about that because it's like, it's the simplest thing you can do is send an email, send a text, or pick up the phone and make a phone call and just go, hey, Daniel, here's my situation. How would you help me?
That's it.
That's it. That's where it starts. You might love it and you might go, oh, crap, I don't know what to do. Daniel's going to be there for you. This is why we keep bringing him back because we've got more topics. Daniel will be back. Don't stress.
I'll be back again. Don't worry.
Oh, don't worry. And we're going to come to you live from a new podcast caravan soon, which will be even more fun.
Very interesting. We'll be driving right in the middle of the podcast on wheels.
We actually will, though. We're going to drive right past your house and shout what we do.
On the Hume Highway somewhere.
Yeah, somewhere. We'll have like the speaker out the front.
Yeah.
It'll be a full-blown thing.
Why not? No,
but Daniel, thank you again for coming back on the show and sharing your wisdom. And as always, everyone, we have Daniel's details in the show notes below. So make sure that you go there, check out his website. It's Mark Daniel & Co. And make sure that you actually get the support you need. Just have a chat. It's not going to cost anything. So thank you again.
No worries. Thanks, Joe. It's great to be here again.
Always.
I'll be back again.
Oh, he'll be back like the Terminator. But we're going to be
back.
The tax Terminator.
That's a good one. I like it.
I
like it.
Yeah, maybe Karina, write that down for an episode.
I'll wear the glasses next time.
Oh, please. Can we wear Speedies? I digress. Thank you all for our listeners for tuning in every week and being so loyal to the show and for submitting all your questions and all of your scenarios. It helps us make this a reality. So all the links to Daniel are in the show notes below. And if this helped you, share it with a friend who still thinks, I'll just wing it at tax time. They need to hear this.
Yes.
So we'll see you next episode from the podcast Caravan. I'm Joe Agresta, and this has been the No BS podcast with Daniel Demirci.
Thanks, Joe. Great to be here, and we'll chat again soon.
Chat soon. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodey AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodey.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodey AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodey.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.